Hello, everyone, and welcome back to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating the session tonight with Mr. Rob Roy. Excuse me. Before we get into the good stuff that we're all here for, we have to go over some housekeeping details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We have this available on our website, so please feel free to take a scan through that at any time, or feel free to take a screenshot of it now if you like, but that's the main point to take away from it. Now, most of us are likely familiar with the Q&A process for when that comes part of the session. Rob will go through his general 45-minute presentation and analysis, go through the case study considerations for the coming week, and with the time remaining, we'll open it up to questions. And we do have a plethora of very highly intellectual questions and well thought out questions that we just unfortunately can't get to in every session due to the time constraints. So with that, take it as encouragement to attend the insiders meeting, where you have a 45-minute Q&A portion with both Rob Roy and Jeff Beamer. All right, so that covers off all the housekeeping details per usual. The market continues its historical move higher for the time of year, but FedEx fell on weak guidance, and I don't really know what that means about the consumer. I'm curious as to what Rob has to say about that. And also very excited to interact with you all. So thank you for joining us for this live session. And at this moment in time, the man of the hour, Mr. Rob Roy.
Hey, Zach, how are you? And welcome, everyone, to this week's TradeFinder Live. Lots to talk about tonight. And as you mentioned in the intro, the market has continued to power to the upside. Go ahead and turn my video on so you can see me. I am in the Dragon capsule, all kinds of travel going on this time of year. And I'm sure you all are as well in the holiday season and back with the time in Florida, which feels like it's in the mountains, because I can tell you it's cold outside. You may see my Rowback for anybody that plays golf shirt on. Snuck out for a few holes after the market closed today, and it was cold outside, so it felt like I was back up in the mountains. But as far as this time of the year, the market does tend to march higher, and that's exactly what happened today, closing on the highs of the day, as you can see. And then as Zach mentioned, if the consumer is spending, if we're buying things, it seems like we would have UPS, FedEx, all of the carriers reporting that business is really good. And FedEx didn't say that. In fact, their guidance was down weak. Now, what do you read into that? Because there's two sides of the story. The first side is that maybe the consumer isn't spending as much. Maybe they're not buying as much things from Amazon and all the other retailers that send from the different carriers, and that the consumer has weakened due to inflation and higher interest rates and all those kinds of things. Or is it just the fact that companies tend to guide lower because that's kind of the game that's been going on for a while, under promise, over deliver. So you guide lower and then you turn and move back to the upside after that. So is that what they were doing? Were they playing that game, or is really the consumer a little bit weaker going into this holiday season? Nonetheless, it's seasonally a bullish time. We've talked about that. The market does tend to drift to the upside during this time of the year, and that's exactly what has been occurring so far at the beginning of this week. And you can see the move above the 10-day moving average. We're not really that far overbought away from the 10-day moving average, so it's not like we're overbought short term. You can see where that label is here. For those of you that may be brand new, this program is from the Hub organization. You can find out more about it at hubb.com. It's called Profit Source, and the live version, which we're all so excited about, is in beta now, and we will be utilizing that at the beginning of the year, so you can have live Elliott Wave charts, and that's pretty darn exciting. So we can't wait to see that moving forward. But what this means is that this 5 here, again, for those of you that are new, means that the Elliott Wave algorithm likes this price. It likes this price on the S&P above 490. Since we're in a wave 3, what can occur is that the market can continue to move up and hit that target right there in the wave 3, and these two projections will both move. The wave 4 will move and the wave 5 will move. So this 4 does not mean that we're in a wave 4. It means that if the wave 4 started now, we would move down to the upside here and then move higher here. But oftentimes when you're in a wave 3 and it has some strength to it, you continue to run up toward that level within the wave 3, and then again those two levels change. What we want to look at is the DMI when we see these kinds of things going on, and you can see that ADX is extremely strong. It's above 40, so that's a little concerning there that the ADX is so high. The positive directional indicator is moving higher, the negative is moving lower, so the width is also important, and that continues to expand. What can happen here is that as this continues to move stronger, the move above 40 is still showing strength, but it's not as strong as the move from 25 to 40. So, it's a different qualification of what does strength mean. So when you're looking at this indicator, this move here in November, which is where we started, as I move the arrow up here, that part of the move there was stronger than this part of the move. But we kind of know that because I've talked about this over the last couple of weeks, that this time of the year, especially if investment managers have met their quotas, so if they get their bonuses, they tend to go away. After Thanksgiving, they just disappear until the end of the Christmas holiday season, and then they come back in January. And those that haven't met their targets yet are chasing, and they're trying to find out where's the sectors that we can generate the most growth so that we can achieve results in line with the S&P so that we can receive our bonuses. So what this means is that this move has some strength to it, although not as strong as the first part of the move, and it would not be surprising based on that DMI to see the wave 3 continue up to 490. So we just continue to follow the charts. I know a lot of people are a little bewildered by this move higher. The comments on YouTube, a lot of people are like, what is going on? How is the market moving higher? And we can make all of our assertions as to why, but the bottom line is that's what's occurring. And you have to trade what the market is giving you. And that's what we've been doing at ewotrader.com. So it doesn't look like we're done moving to the upside yet. The last piece that we want to look at, because it always matters, is volume. And you can see that there's some pretty doggone good volume going on. Yes, we've dropped off a little bit here over the last few days, but again, at this time of the year, it's not that surprising. Kids are getting out of school. Different states have different days when the kids are off, but some kids are already out of school. Some are getting out within the next few days. And travel occurs. All those kinds of things happen this time of the year. But we had a this is, to me, when you see this kind of a volume spike, and it's almost to the point, and you've heard me talk about this as well, when you get to big volume spikes on a move, you get to the point where it's like everybody that wanted to buy has bought, and then you get a little bit of a quiet period where there's not as many buyers. Market tends to correct or pull back a little bit, but it's hard to look at that this time of the year with these last couple of days, because that's more normal. And this spike is just not quite high enough to say that all the buyers that wanted to buy have bought, especially when you see this move to the upside. What's occurred the first part of this week, yesterday and today, is exactly what normally occurs this time of the year. For those of you, I'm not so much of a person that looks at the seasonal trends of the market. Although if there was one seasonal trend that I would look at, it would be, yes, this time of the year, the market tends to drift higher on lower volatility. We've certainly seen that in our own time strategy with the lower volatility. We like volatility for that strategy, but the impulse strategy has been on fire, which is our directional strategy, because we've been trading along with this move to the upside, trading what the market gives you, and that's how you become successful. Trade what the market is telling you, not what you think the market is going to do, because I can tell you, I learned this a long time ago. I felt like when I first started trading, the more I learned about the markets, the more I learned about the economy, et cetera, how everything intertwines, the smarter I thought I was. And I would start to trade based on where I thought the market was going to go, based on the education and knowledge that I had, rather than just trade what the market gives you. And so that's where we are now with this potential move higher. So we can have lower than average volume as we move all the way to 490. In fact, if we do continue to move higher, based on what the DMI was showing you, I would just ascertain that it's likely, if the market does move up to that 490 level, it will probably be on below average volume, again, because that's what normally occurs this time of the year. So not really a conundrum here. When we look at the market moving higher, we expect the consumer to spend, but then FedEx is concerned about where we're going to go first quarter of next year. All those things. We'll talk about interest rates here in just a second, but I did want to share those thoughts with you, as it does look like the market wants to move up towards 490 by the end of the year. Now, we do have that period of time between Christmas and New Year's. It's called the Santa Claus Rally. And that's when, I mean, there's very few traders there. And unless something really negative happens, the market tends to drift higher that week. And that's why it's called the Santa Claus Rally, because, of Christmas, et cetera. But the other side of the coin, so I always try to present both sides, right? Some of you don't like that, but I feel like that's prudent, that everybody needs to know what could happen if we're wrong. So if the market doesn't drift higher into the end of the year, what could happen? Well, on lower volume, you could have increased volatility if there's negative news. We have some unrest around the world. Everybody knows what's going on with Israel and Palestine, et cetera. And then you're reading about other things that are going on involving China and Taiwan. All those things are still out there. So if something really unusual happened, you could get an exaggerated move to the downside. But aside from something really negative happen, what normally happens is that we drift to the upside. So let's take a look at the TNX. And that'll give you an idea of what's going on with interest rates. They've been kind of stabilizing here in this Elliott Wave pattern down here around that 61.8% level. I talked about this earlier in the week in one of the live broadcasts that I do, and we'll talk about a little bit later on that we come down here, and if we break below this level, much more, I wouldn't be surprised because it's really hard unless the inflationary data just starts to reverse course because it's been weakening. We had some Fed speak on, we're not talking about raising rates yet or lowering rates yet. The market might be a little bit ahead of where the Fed is. That was some of the commentary from the Fed governors that the market may be ahead of where we are. But then CNBC had that survey that I talked about last week that said, according to their Fed survey, the market is expecting the Fed to cut rates around summer of next year. What could cause that? It isn't going to be where the market is right now. So if the Fed is going to cut rates by summer of next year, you would expect to see some recessionary data come in after the first of the year. So how strong can the consumer be? You've all heard about, record levels of credit card debt, car payments starting to go into, late payment mode, and you hear all of those things, and yet the market still continues to go higher. So maybe we see some increased volatility. That's what I'm expecting, is that we see some really increased volatility right after the first of the year. But is it going to be the interest rates turn and move to the upside? I don't know. I don't see that happening. I think we're more than likely to see interest rates stabilize, maybe drift enough lower to disqualify this five-wave pattern. I just can't imagine the inflationary data coming in strong enough to turn this chart on the TNX to where we have a wave 5 move up to 5.5% on the 10-year again. I just don't see it. Now, it could happen. Just because I don't see it doesn't mean that it can't occur. But that's really hard for me to imagine at this point. And then we're also getting some help from the dollar. I do have the Elliott Wave button on, and no longer do we have an Elliott Wave qualified pattern on the dollar, which is really interesting. Where I just talked about how we could disqualify this pattern on the 10-year, the dollar has disqualified any sort of a extensive move to the upside there. So maybe the dollar is a little bit in front of interest rates here, and we could see this exact same thing play out on rates. I talked about this last week as well, that we want the dollar, well, if you're long the market. If you're short the market, this isn't what you want. But if you're long the market, you want to see the dollar stay right in here. I call this a sweet spot, right in this area between 107 and 101. We do have the lows there below 100. My extreme low on the dollar, if you've been following us for months and months, is down around 96. So even if the dollar were to break that support level at 101, I'd still be okay. But if we started to see the dollar move below 96, I'd be really concerned about where things are economically. So here's what could play out. If we start to see some really bad economic numbers at the beginning of the year, we could see the dollar break down, break below this level. But then we get to a point where if it's really bad, then if you have a global recession that were to occur, you would start to see money move back into the dollar because the dollar is the currency of last resort. But right now, people seem to be more focused on the amount of debt that the U.S. has. That's causing the dollar to move to the downside. But if we stay in this range here, and I could make an argument on my number down here around 96, that it's even a bigger window here. But I'll take that off for now because we'll just go with what the charts are showing at this point, that if we stay somewhere, just call it between 100 and 107, that's the sweet spot on the dollar. If we stay within there and then we were to see the five-wave pattern go away on interest rates, that's a good scenario for the market to continue to move higher. I think that we have to discount what's going on between now and the end of the year. And then when we get into that first week of January, when all the traders are back, all the volume comes back, then we'll really find out where the rubber hits the road. But that'll also tell us whether FedEx was just playing possum with us with their weaker guidance, or if there is something nefarious going on with the consumer, that they just tap themselves out in this holiday season, max out every sort of credit that they have, and then we start to have real problems with people making their mortgage payments and car payments and all that kind of stuff. Those are the kind of things that could prompt the Fed to begin to cut rates. So I do think that we need to be really on call for some sort of volatility to occur in January. But at this point in time, it seems as though the market wants to continue that normal seasonal move to the upside. And I think there's just enough negativity out there, just enough negative concerns, negative news to where the market could move higher. There's an old adage, the market climbs a wall of worry. And we do have worries. We do have concerns. We have a lot of debt in the U.S. The consumer has a lot of debt, all those things. But the consumer is going to do everything they can to spend this time of the year. So we trade with what the market is giving us now. But keep in the back of your mind that things could change significantly in January. We could have significantly more volatility. And I really think that's the likely outcome. So speaking of volatility, let's look at the VIX. And we're just hanging around this 13 level. And gosh, if you watch an intraday chart of the VIX, it's almost like the VIX is doing everything it can to continue to drive the market higher. You get spikes up and then it comes back down. And then as soon as it gets low, it spikes back up again. It doesn't seem like the volatility index wants to go below 12 right now. But here we are right in that area. And if you've watched the markets for years, you know that we have been below 12, 13. We've been down to 10, 9. I don't know that we go that low as we move into the end of the holiday season. And perhaps we just have enough of a drop in volatility to have a little bit of a drift higher into the end of the year. And then watch out for the volatility to come back in January. And perhaps we see that volatility index spike back at that point in time. But you got to be on your toes. I don't think this is, even though I'm talking about the market seems to be acting, and as Zach said in the beginning, moving to the upside in the traditional time of the year where it does, but there is enough unsettlement going on out there that one really negative headline could change everything. But just keep that in the back of your mind and still trade what the market is telling you at this point. And then if it changes, then we'll change along with it. So looking at the rest of our U.S. markets, we look at the Dow. And if we take a look at the DIA, goodness, look at that chart. Wow. So the S&P chart looks pretty good, but look at that on the Dow. And if we turn the Elliott Wave button on here, you can see that we could go up to 390. Isn't that interesting? Same price potential on the DIA as we are on the SPY, just at 100 points. So 490 on the S&P, 390 on the DIA is where the Elliott Wave algorithm likes to see the market go. This is a pretty constructive move to the upside. We are a touch more overbought on the Dow than we are on the S&P. Not extremely so, but a little bit overbought on the Dow. So let's take a look at the DMI here, and it's identical, isn't it? And when you have the markets in concert like this, that gives you more confidence. When you get a little bit concerned is when the markets get discombobulated, and we've seen that enough over the years where the markets weren't in sync with each other. But the DIA and the S&P are really just almost identical patterns. So let's look at the Qs and let's see what those are telling us. And as you would expect with interest rates giving us a little bit of a break, we're climbing up higher there on the Qs, 420 being the level there. Just this is the kind of move that I like, and this is what normally happens this time of the year, is you just get this slow, steady, low, small bars intraday. So you just get this nice little climb here, 420 being the level. You look at the DMI, and it's identical to the DMI on the S&P and the Dow, where you have the ADX showing a lot of strength, no turn back to the downside, where we'll get concerned. So if you're wondering, okay, well, how do we know when things turn? It's when the ADX breaks back below 40. So you look at that level of 40 on whether or not you're looking at the S&P, the Dow, the Qs. If you see that ADX turn and break back below 40, all this is over. And then we start worrying about corrective mode and when the market could go lower. And then we look at the IWM, which has been just really mind-boggling, where we got to the point where we thought we were almost in. Zach loves this phrase that I say, the Katie bar the door zone. We broke below 170. We came down to the last bastion of support at 165. Anything below that, and the IWM completely falls apart. But it didn't. It turned and moved back to the upside. It's in a wave 3 to the upside as well. And look at the DMI. So all of the markets, the S&P, the Dow, the Qs, and the IWM all have the identical DMI, all showing strength, showing that, yes, we could move higher, all having higher potential targets, but weaker moves to the upside. Again, what you would expect this time of the year. So all of the major markets are all basically showing us the same thing. And now with the IWM, we've broken above this whole 190 area, which has been resistance going back a couple of years, where we were staying between 170 and 190. So we held in this range here. Now, if you go back even further, the range on the IWM was between 190 and 210. Those of you, again, that have been watching us for a very long time know those levels. And look where the wave 5 forecast is on the IWM. 210 right there. So could we get to the point where 190 becomes support again? We'd have to go back a ways on the IWM before we saw where 190 was support and 210 was resistance. So the markets are all lined up. They're all showing us the same thing, which means that what you look at now when you see all of these markets lined up like this, pick your favorite market if you want to trade for a drift higher, or within these markets, pick your spots. Find the stocks that have not performed as well as their sister stocks, if you will, within the various ETFs, indices, whatever, because that's likely where money is going to rotate. Because as I said, the money managers that have hit their benchmarks are not trading right now. It's the ones that are chasing. And what they try to do is they find stocks. Okay, what stocks within each sector, a sector that's been performing well, what are the stocks that have been underperforming? And that's where the money goes. And that's where you can generate some gains by the end of the year, so that maybe they hit their performance targets and get their bonuses as well. So what you want to look for is, it doesn't matter what I'm saying right now. It doesn't matter whether you look at the S&P, the Dow, the Qs, or the IWM. Look within those markets and find the stocks that have been underperforming of their sector peers in those markets. And that's probably where the greatest gains are going to be between now and the end of the year. So it is a stock picker's market more than ever before. Not more than ever before. That's not a true statement. It's a stock picker's market right now, and not so much on the indices, because they all look exactly the same as far as projections of continuing move higher, all showing strong ADXs, all showing extended ADXs. So you need to find those particular stocks within the indices if you want to generate the highest potential return. And I can promise you that that's what investment managers are doing right now. So if you can find the right stocks, you can find some really nice gains within these individual sectors. So pretty amazing that they're all lining up like this, and then all showing the exact same DMIs. I know I talk about the DMI a lot. I think that if it's not one of your favorite indicators from a technical standpoint, it ought to be. And so take a look at it. We're looking at some of the international markets. Look at what's going on down under with the Aussie market. The EWA, here we have gaps, which we get because it's an international market. And so, you see what happens overnight, and then the market catches up. It's not unusual to see gaps here, a lot different than what we talk about with gaps with stocks within the U.S. markets, but a big move to the upside. You could argue a little overbought now on the EWA. But then you come down and you look and you can see that the ADX is just at 40 and well within a wide range of separation between the positive and negative directional indicators. So if you like to trade markets rather than individual stocks, and you're looking for where's a market that I can look to trade, maybe looking at the EWA. I would caution a little bit because it's a tiny bit overbought based on this big move to the upside today. but the ADX, as based on the DMI, is not quite to the levels that we see in the US. So maybe that's going to catch up. So maybe we continue higher on the EWA. So let's look at Canada. Our folks up north, and again, very similar to what we saw in the EWA, much better looking DMI as far as it's not so strong yet. Gosh, it looks like the EWC wants to move higher. You could argue that that's one of the best looking charts that we've seen so far. And if you're looking for some sort of an ETF to trade, or you like trading, company or countries, then maybe that's where you want to look. And then let's add Germany in here with the EWG. We know what the past was, where it just seemed like that it couldn't get out of its way. And now all of a sudden, the chart of the EWG looks exactly like, at least from the DMI, the S&P Dow, Qs, and IWM, where we have a very high ADX. So if you're looking for a country, it does look like, at least at this point, Canada is the leader. But then let's look at the INDA, which has just been on fire. And love this chart moving to the upside. It's getting a touch vertical here, but not too bad. We're not too far away. I don't know. I guess we'd have to get a protractor out or whatever to see what exactly that degree of movement is, but it kind of looks a little bit in the line of a 45-degree angle, which is my favorite move. And look at that DMI. So as well as the market in India has performed, it looks like that wants to go higher. Now, when we look at the wave 5, we have to move the chart over because the projection's all the way into next summer, which is when the forecasted rate cuts here in the US could occur. So based on all the markets that I've showed you, all the US markets, the international markets, if you're looking for one of these ETFs, like which country's ETF should I put money in? I think you look at the EWC and the INDA, and the next one might be down under with Australia, or if you want to stay at home, just pick your favorite US market because they're all almost identical. But the INDA really looks like it wants to move higher, and I just have a hard time believing that it's going to take all the way to next summer to move up towards that level there around 52 based on that chart. It just seems like even if you get a little bit of a correction, because we're a tiny bit overbought here as well, that perhaps the INDA continues to move higher, and that's a good place to be also. So, that's pretty impressive with what's going on with all the international markets. So I think you have plenty of places to put some money if you're interested in. So to summarize all of this stuff before we move on to the other aspects, I know I'm talking fast, but it's because I got a lot of stuff to share with you tonight. You can see that there's places internationally to put your money. And if you want to stay in the US, find underperforming stocks within your favorite indice, your favorite sector within the US. Those are places where I think you can make the most money between now and the end of the year. Now, y'all probably know that last week we had Jeff Beamer on, who's one of our traders at evotrader.com. He gave you a trade looking for a breakout, which is part of the delta neutral income strategies that we look at. And you can see moving through here, that's what we looked at. I even added in on top of, see, he does volatility work. And he was looking at CarMax as a stock that could potentially break out on earnings. And there's the earnings coming up. So Jeff showed you that chart, and hopefully you all followed that because look where we are now. And I spoke to Jeff earlier. There's your breakout. That's the best scenario you could ask for. So you get a breakout before earnings. Why is that the best scenario? You're like, well, wait, let's just wait for the earnings report. Well, volatility comes in prior to earnings, so you get the big breakout before earnings. So if you all followed that, you should be very happy, and you should have generated a very nice gain already. And this is one of those, when you get the breakout in front of earnings, you can take the position off and take your profit, and then you don't have to wait for the earnings report. Because if the stock doesn't continue to break after earnings, the volatility will come down. So you get a gift when you get the breakout right in front of earnings, because not only do you get the breakout, you get the volatility rush that continues into earnings. And so hopefully y'all followed that and you generated a really nice gain from that move. I thought that everyone that had been watching that might really enjoy seeing that breakout move. So really, really impressive there. Now, staying with that theme, I was talking about with Jeff and his income strategy. We have the time strategy with EOTrader.com. Y'all are familiar with my strategies, but I thought I would show you this as well. So he has two strategies within this delta neutral income strategy that is combined with our time strategy, my time strategy. And here's one on EOG. So we made 40% within a week on this. This was an Iron Condor. So this is a stock that's expected to stay in a range, and you profit from the volatility coming down. So you have this strategy where you create the Iron Condor, and volatility is already rushed in, and then you profit when the volatility comes down. But then you go back and you see the strategy here where volatility broke up out of the triangle within the CarMax trade that he shared with you last week. So a perfect example of what Jeff has shared with you and what his strategies are. I showed you this, but I want to go back and reiterate this. If you were here last week, we have a new strategy here at EOTrader.com, which combines both our income strategies. So my time strategy, his delta neutral income and breakout strategies. So you get both of us. We have Jeff is a trader with EOTrader.com, along with myself. We have our own individual portfolios and strategies, but never have we had a combination of the two of us together until now. And so we call this income trader. So you get both of us. So you get the two traders combined here at EOTrader.com, and you can sign up for this. This is a special that we're running between now and December 24th, and all you have to do is click on this button where it says subscribe. Zach will be putting this link in the chat box as well, I believe. Zach, if you could put that if you haven't already. And so basically what you're getting, here are the results. 70%, 69% winning trades, the average 21% return on each trade, 171% on the account that's occurred. We average about 12 trades a month. The average trade size, look at that, $296. So you don't have to have a whole lot of money. If you're wondering how much money, because we get that question all the time, how much money do I have to have in an account? Well, how many trades do you want to put on? So if the average trade size is under $300 and we're doing 12 trades a month, then that gives you the idea. So a $5,000 account is plenty to handle this. We have a 2-to-1 win ratio, win to loss. We send you out alerts via SMS and email, so text and email, and you can go back and see here's our results for the year of 2023. Now this is only through the end of November, and I can tell you that December is super positive already, but we are showing you the results through the end of November, and here's the monthly returns. The average is $778 a month. The worst month that we had was March. That's the worst month at $182. Well, the entire strategy only costs $179 a month. So for the entire year up till the end of November, and again, December is already on pace, every single month covered what your subscription cost would be. And included in that, we have a bonus of education. At EOTrader.com, we're not just an alert service. I know there's a lot of alert services out there. That's not what we're about. We want to educate you as well. We want you to understand what you're doing. We want you to learn from what you're doing. And hopefully at some point in time, you're able to do this on your own. I've been trading for 27 years, Jeff's been trading for 35 years. We don't need to do this. But we do because we want to give back. I know that sounds cliche as hell, but it's the truth. And so we want you to go through and take advantage of the education so you can do this on your own. You'll learn about these strategies that are listed here. You can see that we profit when stocks stay in a trading range. We're also going to do a couple of live classes so that we can go through and explain these in great detail. The classes start. The first one is going to be myself on the 31st of January. Jeff is going to come in the following Wednesday on the 7th of February, and we'll go through and tell you about these in detail. Everything is recorded. You get a workbook. People love our workbooks. People ask for the workbooks before they even want to know about when the sessions are. So you get a workbook that has all the details of all the slides, everything we're going to show you, a place for you to add notes while you go through. And if you're not able to make the live sessions, no big deal. Everything's recorded. You can access the recordings whenever you want. And so all you have to do to sign up, this is the season of giving, right? And we're used to giving to others. Why don't we give to ourselves at a point in time? Why wouldn't you give yourself a present for 2024 and a present of learning and educating yourself and making money while you're going through your education? All you have to do is put in your phone number. Why do we need your phone number? Because we need to send you out the text messages and the email address for the emails, and then your credit card information. You do have to say you looked at the terms of service, and unfortunately in this time of the world, you have to put in, I'm not a robot. So you have to click that button and then hit the subscription. So if you're not already an alert subscriber with ewotrader.com, it's $179 a month, and I've showed you everything you got. Now, if you are already an alert subscriber with ewotrader.com in one of our portfolios, contact support, and I'm going to ask Zach to put in the communications to access our account services at ewotrader.com. And I can tell you, if you're already a subscriber, we've had people that have contacted them, and based on portfolios that they've already had, we've had a couple of people that have contacted them. They've added this. And remember, this is the first time we've ever had a subscription with both Jeff and I together. They've added this as an additional service and lowered what they were already paying per month because they didn't realize that there was some special that they didn't take advantage of. And the way we work here at ewotrader.com is once you take advantage of a special price, you're grandfathered in forever. So we've had people add this service and lower what they were already paying per month. So if you're already an alert subscriber, contact account services and let them walk you through and see what you have and see if they can't save you some money. And then if you are already, or you're not an alert subscriber, you can sign in for $179, and we will have people with that education that I showed you at $599 that will come in and buy just the education. We have a lot of people. Maybe you've seen our commentary on our YouTube channel, Elliott Wave Options, that talk about the quality of our education. A lot of people give us kudos. We take pride in the quality of the education. We'll have people that'll come in and just pay the $599 for the education, but we're going to throw that in for free if you become an alert subscriber. So again, in this time of year of giving, sometimes self-love is not a bad thing. Give yourself a gift this year for moving into next year. And I don't think that's any sort of a selfish thing, because if we all generate more income for ourselves, then we have more opportunity to help family, friends, etc. And I've had the opportunity through my life to help a lot of family members, extended family members, etc. So I wanted to share that with you. Please take advantage of it. This is a great deal. And again, we've never offered a subscription with the two of us put together. And I just showed you two different ways that you can make money from his side, because you're used to seeing my side. So I'm not going to show you one of my trades for this week. We'll show you one when we come back after the holidays here on TradeFinder. But let's go through and look at previous case study considerations that we've looked at on TradeFinder. And as you know, or maybe you don't know if you're new watching TradeFinder for the first time, we find trade considerations here, but then you're on your own what you do with it. But as an alert subscriber, we send you out alerts for entries, any adjustments and exits. So we hold your hand and walk you through from beginning to end on any sort of potential trade alerts and help you with the strategies, etc. So we only have a few that would be considered open. BP has been one that, as you're probably aware, the energy sector has not performed well. It's come down, and we've said as long as it stays above 35, we hang in there. And we're starting to see oil maybe want to take a look at some sort of a bid, so we could start to see this break back to the upside. But and Zach has talked about this, and I've referred to it in the past. Led Zeppelin's song remains the same. That's where it is on BP. As long as it stays above 35, then you kind of want to stay there. And then we look at MPLX. We're right back where we were. So this is kind of a status quo here. We'll see if we can break above this area here around 36.5. If we can, then that's probably off and running. So you don't want to get out of that one yet. We're right at the same price as the entry. Visa, now we did send this one out as an alert to our alert subscribers, and we're already out. And you can see why. So if you've been following along with Visa and you haven't taken it off, maybe you're getting a touch greedy. You could say, hey, well, it's the time of the year where people are spending money, so I'm going to stay with Visa. Well, that's up to you, but we close it out. We took the gain on this big spike to the upside here, but a nice move higher on Visa. Then we looked at Apple on the 5th of December here, and then you can see that we have moved higher. Where were we? We were at 193 on the entry, and we're at 196.94. So Apple continues to move higher. So that one's profitable. I think we might see a little bit more move to the upside. Last week we talked about how let's see if it can break above that 200 level. Well, we bumped it and came back down. But let's see if we can gather enough energy and momentum here. We're still above the 10-day moving average to take another run and break above that. So I think you hold on to that one. So I think you're out of the Visa trade, but perhaps you hold on to this one. And then the KMX trade that Jeff gave you is gold. It's the best scenario that you could ask for. So that one should be gone. So that one's off. So that only leaves a couple of our open alerts that are left for the trade considerations. And if you're new to TradeFinder and you want to have some sort of confidence in what we do here, go back and look at the previous TradeFinders. Go back a couple years and see what these case study considerations that we've looked at have done. You could have done really well following those. But would you know what strategy to pick? Would you know when to get out? So that's the consideration on becoming an alert subscriber. So take advantage of signing up now, between now and, I know I talked about this last week with some folks, but there were a lot of people on Black Friday, Black Friday specials, because I was looking at some things and I bought some stuff just like most people do on Black Friday. And there's some few things that are like, yeah, maybe I'll wait till after the first of the year. So the Black Friday prices come out, and then on Tuesday, because we have Small Business Saturday, and then we have Cyber Monday, and then on Tuesday, the prices were exactly the same as they were on Black Friday. But I can tell you that price on the combination of the two of us put together is going to go away on December 24th. That'll be the last day. So don't wait till December 24th, because you got 5 days. You could have enough trades to pay for a month. And that's the last thing that I wanted to share with you along those lines is we don't charge a month in advance. We don't do anything like that. It's a month at a time. Kick the tires for a month. What do you got to lose? If you try it for a month and you don't like it, you can cancel at any time. And we make it as easily as possible to cancel. So there's no annual commitment, nothing like that. You can give it a try for a month, see what you think. And if you don't like it for whatever reason, then move on. But you have all this additional commentary, two traders that have been around a very long time, helping you to go through your education and learn more. So it's a fantastic thing for the end of the year. So that goes through our case study considerations. And I've been talking fast and we're still going through time, but let's see if we can find one for this week. So I'll bring up my search. and see. And those of you that have been with us know that I don't pre-look at these. There are 5 results on my search, which, by the way, if you become an alert subscriber with EO Trader and you have private source through Hub, again, hubb.com, if you want to find out more information about it, you get my searches. They're included in there. So let's see what we have here. Academy Sports, Public Storage, and the MSCI, and I'm not really sure what that one is, but let's take a look, because here's a retailer, Academy of Sports. If you ever been one, it's a big, huge sports thing, just like a Dick's Sporting Goods, etc. They have anything in the world you can think of. They're massive stores. Gosh, I really like this one. I think this is going to be our case study for this week, especially with the consumer spending time, good solid volume. That is the best DMI setup you could ask for. The positive directional indicator is moving up. The negative is diving down. The ADX is moving up. I showed you how it was extended in a lot of the U.S. markets. It's moving up towards 40 here. That's great. So the target price here is right around 70. And you take a look at that. The DMI seems extremely supportive of that moving higher. So that's going to be our case study for tonight. So we'll save a little bit of time there by picking the very first one. I did not pre-look at that. I don't do that. I'm very honest with you with that. When we do these TradeFinder things, I wait and look through the searches with y'all because I think that's the best way to learn. I just talk it out with you. You hear my thought process, etc. And I feel like there's a great chance we're at 63.56 on the close today. I think there's a great chance Academy of Sports goes up to 70 probably by the end of the year, at least the beginning of the year. And so that's a great one to look at. No guarantees ever, but it's a pretty good one to look at from a bullish standpoint. And Zach, goodness, I've talked as fast as I can, but we're still at 9:50. So let's see if we can get a few questions between now and the close, and then we will wrap things up until the new year here for the folks at TradeFinder.
Yeah, no, I was going to say I can relate to running long, even in my new subscriber calls, which are not near as intensive as this. I still feel like I'm talking fast and have so much material to get through. So I get it. And I think that was some very valuable content worth sharing. Hopefully everyone will take advantage of that offer before it expires, like you said. So both those links are in the chat for everyone there. Let's hop into some questions with the time remaining. Let's check out SoFi.
Oh gosh, we haven't looked at that one in a while. So let's see where SoFi is, and I'm leaving the DMI on. The only issue here is we're right at resistance at $10. You've heard me talk about this in the past, the relevance of the $10 and $5 price levels, and it has to do with investment companies and their investment objective. If you're growth in income, etc., you can trade $10 stocks. To trade something below 10, you have to be registered as aggressive growth to trade a $5 stock. So that $10 level is really key. In addition to the fact that it's resistance, the DMI would allow you to believe that perhaps on this run we break above 10. We tried it back here at the end of July, but if you've been following us, you know one of my rules is you have to have a second day of follow through, a confirmation day, because the market gives you a lot of head fakes. There's one right there. That's exactly what happens. That's why there's the rule of a second day or a follow through day. So it tried to break above 10. It couldn't do it there. It tested it back in June. Now we're here again. My mentor, when I first learned, and I think that's extremely important, because the market will teach you if you want, but that's a really expensive way to learn, is to let the market teach you, because it spanks you pretty hard, or you learn from someone that's been doing it a while. That's what I did when I first started. My mentor would say the third time's the charm. And what that meant was when you come up to a resistance level or support on the way down, the third time, whatever happens there is what normally occurs. So what that means is that we tested 10 in June. We tested 10 at the end of July and early August. Now we're testing it again. If we break above 10 with a follow-through day, based on what he taught me, is that means we're likely continuing to move higher from here. If we turn back down from 10. That would be the third time that we tested 10 and couldn't break it. Then that tells you that it's probably a short, and you may be looking at these lows down here around 7. So whatever happens with SoFi now, if it can break above 10 with follow through, it likely runs. If it turns back, you're probably coming down to 7. So gosh, that one's right in what my mentor taught me, who unfortunately has passed away. But I like to, give him kudos because I wouldn't be where I am today without learning from him. So that was a great one to start with, Zach. So let's continue on.
Yeah, we hadn't looked at that one in a little bit, so I thought that would be a good one for you. So let's
Yeah,
go over
absolutely.
to LCID.
Oh, my good friends Lucid. And gosh, if you've been following me, I've been all over the place lately. I've been in the mountains, I've been in New Orleans, I've been here. Not getting a lot of sleep, a lot of travel, and I don't travel during market hours, so a lot of travel time lately. And I can tell you, I've seen a few of these cars. You probably heard me talk about this before, where I said I like the car better than the stock. But look what's happened. So we came down to 4. Just when it looked like another Katie bar the door thing, that we're going down, perhaps to the pink sheets. We broke above. We tried to get above 5. We couldn't do it. That was support back there in September and October. So we tested it. No follow through day. We're hanging in here. We are above the 10-day moving average. So this one's really easy. It's got to break above 5 with a follow through day if you want to be long. If you're short, I don't think you want to go short right now because that DMI is trying to set up. The ADX has to break 20. It's not there yet. And those of you that have been with us for a while know that I've talked about this. The ADX will come up and it'll hit that 20 and roll over. That's why the trigger signals it has to break above 20. So if you're short, I think you want to wait. I wouldn't go short this stock unless it broke below 4. Then I think it's a great short. But with the DMI trying to set up, maybe it takes a shot at breaking above 5. And if it can do it with follow through, then we're probably at 6 pretty quickly. But it's got some resistance there. It'll have a hard time getting above 6. We can take a look at it, maybe at the beginning of the year. If we can get above 6, then we're up to 7. But right now, the key is I think it's in no man's land at this moment right now. Above 5, I think you go long at least to 6. If it doesn't go, before I would go short, it's got to break below 4. So next one.
Next one up, let's go over to a firm for Emmanuel, who says it's run over 150% in the last 45 days or less. And would you recommend shorting the stock? Let me know your thoughts and ideas.
Oh, gosh, what's the symbol on a firm?
AFRM, sorry.
Okay. That's what I thought it was, but I doubted myself there for a sec. We talked about this in the past, and for those of you that are doing retail shopping, you've probably seen this everywhere. They've made deals, it seems like, with all the retailers, and it's not surprising to me that it's been moving higher. And if you feel like this is going to be a decent spending holiday season for retailers, then you want to be long this stock. Big breakout day today, slightly overbought. That ADX looks exactly like all the markets ADX does. And then we look up here. This kind of has the same kind of wave 5 as what was at the Indian market that had the wave 5 into the future. But as we talked about, it can go up there sooner. So it does look like we want to break above 50 here, above 60, maybe to 65 at the midpoint there. I think you want to see what happens tomorrow morning. Does it continue this move here? Do we get a little backing and filling? I wish it wouldn't have gapped up today. I hate the gaps, but this looks awfully similar to the markets. So if you're one that believes the consumer is going to spend this season, even if they're going further into debt, more credit card, whatever, I think you need to be long this stock. It's everywhere right now. Doesn't surprise me that it's moving higher. I think I'd be a little more cautious after the beginning of the year. We'll see what it does in January, but between now and then, if you have some speculative money and you get an opportunity, if it runs high in the morning, I don't know if I would chase that move, but if it gives you an opportunity with some sort of maybe a small pullback in the morning or whatever, you could likely see 65 before it's done. But then I think I'd be really cautious of this going into the new year. So in January, maybe we'll look at this one again. All right, let's do a few more.
All right, so let's look at Home Depot HD for Chris. I took it as short based on an overstretched daily chart, big gap up move. I took 119, 355 puts, looking for a retrace. Thanks.
Okay. Well, Home Depot did run up and we did have a big gap and we've been consolidating that gap. The positive that you have on your short position as a deposit directional indicator is move lower than the ADX. What you really want on a short position, in my opinion, if you like the DMIs and indicators, you'd rather see that ADX roll over first. But I do get it because it had a big move. The key here, though, is it broke above resistance at 340 here. So there's a possibility that we have some consolidation here above 340. If you get a move down to 340, I might be inclined to take that. But I would want to see the ADX roll over first before I would go, before I would hang on to a short position. So maybe you get this gap filled, maybe it comes down and tests this 340, but with that wave 5 showing a little bit higher, I would be really kind of tight on your stops on the short position there on Home Depot. If you do get that gap filled down to a test of 340, I think I would take, me personally, I can't tell you what to do. I can't give individual investment advice. I'm not a registered investment advisor. So if we come down to 340, if it was me, I'd take the gain there. But I'd also be really tight on the stops. Because we could do some consolidation here and perhaps move a little bit higher. The most positive thing that I see here is that the positive direction for the short position is the positive directional indicator has moved below the ADX. Those are a little more receptive to day-to-day movements. Rather, the ADX is a little bit more of a lagging indicator. I think I would hold your short position now, but I would be cautious on it. And if it does try to move higher, I think it would take it off. And if it does come down and fill that gap and hold 340 or go down to 340, I think I would take that quick gain and then see what happens after that. So the key here with Home Depot is that if we do see interest rates turn back up, who knows what's going to happen? You know, it's still a wave 5 pattern, even though I'm hinting that perhaps it disqualifies. But if the housing market at some point slows because the consumer gets a little weaker and we do move into a recession, perhaps people stay in their homes longer, which would be bullish for Home Depot. So anyway, long-winded explanation there. We're after 10 o'clock, pal, but let's do two more.
All right, two more. You got it. Let's go with this question here is kind of more of a conceptual question. And there's a couple that are similar to this narrative, so it'd be good to hear your thoughts on it. Hi, Rob. Given many of the recent trades have been in wave 3 progression zigzag patterns, does wave 4 correction and is to be ignored and we look only for wave 5 target price? We'll appreciate if you could elaborate on the thought process behind these.
Sure. That's good Elliott Wave information, which you can find out more about on the education area that we have on our website. We have lots of good education there. I want to make sure that everybody understands that when it shows this wave 4, that does not mean we're in a wave 4. That means that if the wave 4 started now, that's where you could expect to see some support. I do love trading the zigzag patterns within the wave 3, and you can get an idea that the good part about trading the wave 3 is that anyone that has any knowledge of Elliott Wave knows that's the strongest of all waves. The negative is you never know when the wave 3 is going to end and the wave 4 is going to start. But then I qualify that by saying zigzags can help you figure out where the wave 3 is going to end. So if you have a zigzag pattern within a wave 3, I think that's the greatest of all directional trades. I like to focus a lot of our directional trading there. No, I never ignore the wave 4, but I just prefer trading directionally, trading these zigzags within the wave 3. We do wave 5 trades, which is after the wave 4 correction. Never ignore the wave 4 correction, but try to get an idea of where that's going to be. For this case on Home Depot as an example, if the wave 4 were to start now, you would look for some sort of support around 320, but it's not telling you the wave 4 is starting now. So we like to trade for directionally bullish trades, trade the wave 3 to the upside. When that hits our target, keep an eye on it. watch for the wave 4 correction and see if we get some good Fibonacci support on the wave 4, and then you can come in and re-enter the trade on the move up to the wave 5. But as long as we have plenty of opportunities in the wave 3, they're going to be the primary directional trades. But we do trade plenty of trades moving from the 4 to the 5 on the upside. Same thing to the downside. At some point, we'll have a down market again. We'll be talking about this in the opposite direction. But no, never ignore that. But using the zigzags to try to give us an idea of where the wave 3 may end. And just note that when a zigzag target is hit, we're using Fibonacci levels, and we can move to in the next Fibonacci level, which is known as extended wave 3, and we use the DMI to help us there. So if we were to get, let's say, Home Depot roll over here and come down towards 340, I would want to see if the ADX moves below 40. So if we come down to 340 on Home Depot, I said I'd go ahead and take a short profit right there. If we get down to 340 and it looks like it wants to trade below it and the ADX has rolled over and moved back below 40, then I might stay in a short position and wait for that wave 4 target to be hit before looking at maybe a wave 5. So if you really get really good at Elliott Wave, and you learn wave 3s, you learn zigzags, you learn the wave 4 corrections and the wave 5 moves. There's a lot of people that have their favorite stocks, and they get really good at particular stocks and understanding how they move. My favorite's Google. You've heard me say that 1,000 times. Google, just for whatever reason, has tons of Elliott Wave patterns. So if you have a favorite stock and you like the aspects of Elliott Wave, learn all the aspects of Elliott Wave, and then trade your favorite stocks. And you know, you likely, if you have a stock that's really liquid and moves, a la Google or some other stocks, Tesla is another one that shows up a lot on Elliott Wave searches. You can trade your favorite stocks just using various Elliott Wave patterns. All right, one more.
All right, one more, and I do have to say, since it's the last TradeFinder of the year before we return next year, it was a fantastic year interacting with everyone. Thank you all for your continued support and fantastic questions each session. It's really genuinely a pleasure and privilege to interact with you all. So we look forward to all that's yet to come in the next year. And for tonight's session, we're going to wrap up with the powerhouse stock that gets more coverage than, we'll say, COVID, good old NVIDIA.
How did
I passed this through is because Ian put in quotations asking for me, so I knew I'd have an excuse there.
Well, Ian, I know Zach appreciates you asking, and we are at we bounced down today because we came up here and hit this 500 level. You've heard me talk about, you know, the whole old Star Trek thing. My dad was a massive Star Trek fan and was always on reruns, etc. He just loved it. And they always talked about the tractor beam where it drew them in. And I talk about these big round numbers as acting that way where it draws the stock to it, but then it also acts as resistance. And so 500 is the key. So this one is very similar to what we talked about before with my mentor talking about third time's the charm, whatever happens the third time. So here we are testing 500 for the third time on NVIDIA. If we can break above that 500 level with follow through, the Elliott Wave algorithm likes 600. So it looks like another 100 points to the upside, but it has to do it first. Now the DMI is trying to set up, but here's what I mentioned with the ADX is moving up, but it hasn't gotten above 20 yet. It has to break above 20. So I think right now NVIDIA is watch and see. And if we can get above 500 and that DMI sets up, the ADX moves above 20, and we get further separation between the two directional indicators, I think you see 600 on NVIDIA. But it's got to break 500 first, and it has to do it with follow through. And if it can do that, then I think we may have something going there. So NVIDIA right now, for me, is wait and see what can happen here. It did come down. It's developed some support here at 460. So I don't think I would short NVIDIA unless it broke below 460. A break below 460, and then you're starting down here around 420 or so. and who knows what could happen from there. But to go long, it's got to get above 500 with follow through, with some confirmation on the DMI. And if it does, then yeah, I think you got another 100-point move there up to 600. But it has to do it first. So we'll see if it does it. So we'll wrap things up where just let everybody know again, take advantage of this income trader special. Two guys that have been around for over 25 years, all combined, both of us into one strategy. Never happened before. And so give it a month try and let's see if we're right or if I'm right. That volatility is going to come back in January. January could be a fantastic month in the income strategy. Thanks everybody for watching, not just tonight, but for the entire year. I say this with the most passion that I can. Time's the most valuable asset that we all have. We really appreciate when you devote your time to us, and so we do our best to make it a great educational and informational use of your time. Thanks so much for your attention all year. Hope to see you all as alert subscribers for next year. Enjoy your holiday season. Hope you get a chance to spend some really quality time with family, friends, and loved ones, and look forward to talking to you again at the beginning of the year.